Last week, we made the case for whole life and IUL together as part of your financial plan. This week, we're going to talk about loans, wash loans versus participating index loans, the arbitrage debate, and anything else that comes up in this conversation. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, let's talk loans. Loans are kind of a big deal because in our high cash value life insurance, we get tax deferred growth. And as long as we access it through policy loans, we're not going to pay any taxes.
Yeah, and I think that is really a very key factor for getting into this process. When people talk about being able to have tax-free income and various other things like that, tax-free access, we're talking most of the time about tapping those loans in order to use those funds. And really, that's the power of this strategy, this infinite banking concept, is in using the loans in some capacity.
Yeah, sometimes you'll use the loans early in the policy, maybe shortly after getting the policy, maybe in an emergency. But a lot of people do plan to get loans in retirement. And this is kind of key when it comes to what type of loan we might get when it comes to an IUL. And we've got a couple of different loan types, but let's first start with most of the loans that you're going to see in a whole life policy in retirement.
Yeah, the most common approach for whole life, it would be to withdraw up to your basis, so all your premiums paid in, and then you would take your wash loan. It might tend to be a wash loan in that whole life policy where you're paying a rate and earning at that same rate or a very close rate to that. That's probably going to be your most common approach in a whole life policy.
Yeah, most whole life policies, if they're direct recognition, may have a small net cost of that loan, certainly in the first 10 years. But once they get to retirement, I think most of them are designed to be basically a wash where you're going to get an offsetting credit that's fairly equal to whatever you're paying. And that doesn't take into account the underlying expenses that you still have inside of a policy, but it can make sense as opposed to paying taxes.
Yeah, that's the key. When people talk about tax-free this or that, structurally, life insurance is tax deferred and it passes income tax-free to your beneficiaries. But the structure through loans is what allows for us to have that tax-free access. And that is the key to using those funds without paying taxes.
Yeah, so when we withdraw up to our basis, we're going to go through just some brief numbers here. When you withdraw up to your basis, we do that because we don't want to start taking the loans yet. When we assume that there may be a small net cost to the loans. So it's a little more efficient if we start with withdrawing up to our basis. Once we get into the loan taking phase, we have the choice. We can keep withdrawing and pay income tax on it, or we can do a loan that might have a net cost to it. And even in a non-direct recognition policy, there's most likely a net cost there. You're not generally earning arbitrage when you're doing a whole life loan. But now we're weighing the difference between whatever your tax rate is. Let's say your tax rate is 24%. When you have a small net cost to a loan, it may be almost an exact wash, but let's say that there's a 0.5% cost to the loan. It's going to take you 48 years of that very first year of you taking a loan before it surpasses the cost of paying taxes in that first year. Now, if we're talking about taking loans in retirement, you're probably already mid-60s. And then if you withdraw up to your basis, that might put you into your mid-70s before you even start taking a loan. So we're talking age 120, potentially, before you're better off having actually withdrawn and paid income taxes, as opposed to taking a loan in retirement.
And that's why it is the clear winner with whole life, that withdraw up to your basis and take the funds as a loan if you need to continue to have income. I think it's the best strategy, because in the end, whatever's remaining, that the balance of those loans just get deducted from your death benefit. And that's how it wipes out any kind of tax burden, because the death benefit passes income tax free.
Yep. Now, I'm not a huge fan of illustrating loans when it comes to illustrations, mostly because I think that they set unrealistic expectations. Part of it being there might be a bit of arbitrage built into the illustrations. And the other thing is, they're generally going to assume that you're taking out the same amount of money each month or each year. And that's usually not going to be the case because we're probably going to hold in the cash value in that policy with the rest of the financial plan or the rest of the financial portfolio that they built up for retirement. And you're going to draw from each one whenever it makes the most sense. And that plan is going to be specific to each individual when they get to retirement. And I just tend to not like to set that expectation that you're going to be relying on this one tool every single month for the rest of your life.
And that's why a lot in this podcast, we talk about this balanced portfolio. So you may not want to tap, you may finish withdrawing up to your basis in your whole life, and you may look elsewhere, maybe to an existing IUL, because I think the case is a little bit easier on that side of things, especially in those early years of retirement, if the market conditions are looking nice.
Yeah, we covered the whole life when it comes to retirement and the loans, but IUL gives us a lot more options. When it comes to the loan types, you have different ones to choose from, and you can alternate it year to year with almost every product. And some products will even let you carry two different loan types at the same time. And that's kind of a unique feature of the IUL.
Yeah, and the way that I look at an IUL loan, I will tend to default, especially at my age, there's various factors, but I will tend to default to that participating loan. This is why I lean toward it as that first point where I might be taking loans is I'm not interrupting the compounding when I'm taking that loan at, for my case, 5% fixed rate loan, very solid. And I could potentially, and I have seen years where I've earned 12% on those same borrowed funds. So that's the real power where I tend to default in my current stage to that participating loan.
Yeah, so let's highlight that IULs will generally give you access to either a fixed loan, which gives you a fixed credit, or a participating index loan, in which the credit you're going to receive is based on whatever index options you're choosing from, that those collateralized funds are allocated to. So you got two different loan types. Now, there are some products that you only get one loan type, and there's other products where you may have only one loan type in the beginning, and then it opens up later on. But in general, for the first 10 years, the fixed loan option does come at a net cost, and that net cost is usually around a 1% net cost. It's going to vary a little bit. Some of them are lower by a little bit, and some of them are higher. But then after 10 years, you get an actual wash where you might pay 2% and you get a credit of 2%. Or it'll be very, very close to a wash, where similar to in the whole life, just assume there may end up being a small net cost to that loan. And then the other option, your participating index loan, where it doesn't affect the growth in the policy. And most carriers are somewhere around 5%. Some of them are fixed, some of them it's variable, and it could go higher up to 8%. It is something to be aware of. What is the hurdle that you have to overcome to get that arbitrage in your particular IUL product?
And at this phase of where I'm at, I look at it like this. The arbitrage is not a hard requirement, especially in this market right now. A 5% loan is a good rate. So you got to also think about it in that respect. When you have access to a tool like this or like Whole Life, what are you comparing it to elsewhere? And that's why it's really important to capitalize these policies, to have that flexibility. And so I might be paying 5%, and in some years I get arbitrage, fantastic. But worst case scenario, I'm paying 5% and I'm continuing to see growth, if not this year, but then the next year.
Now, let's talk a little bit about the illustrations. Again, I'm not a huge fan of illustrating income in these things, but when we do, it's because a client would just like to see what does it look like, and it does give us a window into how these things work. But most illustrations will assume 0.5% arbitrage when you're showing a participating index loan in an IUL. Now, you may not get 0.5% arbitrage, or you may blow that out of the water. I don't know what's going to happen in the market in the future. And so I tend to not like showing those because the numbers can get really silly. Essentially, when you have an illustration showing 0.5% arbitrage, the more loans that you show it taking, the better the policy is going to perform. And so I've seen illustrations where people will just keep showing more and more money going into this policy just to be borrowed out. And it looks better and better because of the type of loan that they're showing. But it doesn't actually reflect the true risk that those loans might be representing.
And the cash value, so if we put some numbers to it, if you fund as heavily as some of us are in one of these IULs, you might be sitting on millions of dollars of cash value. Let's just say, for simple numbers, $10 million of cash value. When you're paying 5% on some portion of that, maybe $1 million, you got a loan balance of $1 million. What's 5% of $1 million? That's $50,000 a year that's accruing on that. So it is a very real thing. And if you're just these illustrations guaranteeing this 0.5% of arbitrage, it might not be the case, and it's no guarantee that that's going to be the case. So I think it is prudent to keep that in mind if you're seeing an illustration that shows income.
Yeah, there are some illustrations that show a lot of income coming out. And by the time this person gets to 85 years old, you have a very small amount of actual cash value in that policy. And it's assuming that you're going to earn that arbitrage. You might have millions in loans, multiple millions in loans, and there's only 100 or 200,000 in cash value. But 1 year, and you're going to be down to nothing in cash value. And that runs the real risk of a lapse in the policy. If you're in the middle of retirement and suddenly you're out of cash value, you need that policy cash value to retire on, to live on, and it's no longer there. And then the absolute worst case scenario, your policy lapses and you're going to get a tax bill from the government for the gains in that policy. Oh, I hate to see an illustration that shows that much of a drawdown. What I do is we assume that by the time we get to retirement, we have decades of experience owning this policy. And we know if we can expect to get more than 5%. So we know if we can expect that arbitrage when we first start in retirement. But all retirement plans are subject to sequence of returns risk. If the beginning of your retirement years are really bad returns and you don't get that arbitrage, you're going to want to shift to a fixed loan type where you're not having to worry about getting that offsetting credit. And it's not going to run you out of money if you have to keep taking a large amount. On the flip side, if we get at least 10 years of actual arbitrage throughout that, you're going to be comfortable taking out a good amount. So I usually like to illustrate 10 years of that 0.5% arbitrage, and then we just switch to the fixed account, and it gives us a much lower expectation as to what a comfortable, safe amount of income might be throughout retirement. Now, all of these illustrations, it's garbage in, garbage out. So you have to make some type of assumptions just to understand how the product works. But understand, if the numbers don't actually play out that way, you don't get the growth in the index that we're assuming for whatever reason, the stock market doesn't perform, you don't fund the policy the way it was projected, there can be other ways that you could potentially screw up a policy. If that happens, you're going to need to adjust your outlook and what you expect to take out in retirement. And this is where a good agent can come in and basically be your partner on this and help make sure that we have realistic expectations.
Yeah, and I think it's important to understand that when you switch to that wash loan, especially when you have a good amount of cash built up and maybe you've got a lot of runway, the costs and the other factor when we're talking about income in retirement, you can minimize those expenses by reducing to that minimum net amount at risk or that guideline minimum, and that's going to help you with those expenses in that policy. And in a lot of ways, it kind of looks like, or it acts like what your normal retirement account might be, with being, except for the fact that you do have that 0% floor or even 1%, whatever, based on your allocations, which can, in the end, when you have, there are indexing strategies with our top product that have this 1% guaranteed bonus. And that can end up covering those expenses in that policy. And so really your policy is washing. When you're taking those wash loans, it is pretty much just like you're withdrawing from a retirement account in the sense that that offsetting credit should handle the rest of the expense on that, and you're basically withdrawing.
So we talked about whole life insurance loans in retirement. We talked about IULs before retirement and in retirement. But we didn't address the possibility of arbitrage loans in whole life, which there are some circumstances where you could get arbitrage in a whole life policy loan, or at least a loan against the cash value of your whole life.
Yes, I think the most common will be with some type of line of credit, insurance-backed line of credit that is from an external organization. And there's a number of places out there that you can do this. It is one of the most secure assets out there, and you can access significantly more than pretty much any other line of credit out there. And these institutions know that it's a very secure asset to collateralize that death benefit and cash value.
Yeah, so a loan against your whole life policy with an outside institution could offer you the ability to get arbitrage, even in a direct recognition policy. Now, most of the time, we might think that there's an opportunity for arbitrage with a whole life policy using a non-direct recognition policy. This is where the insurance company just has a loan rate and it will not affect the dividend that you get. And then you get a company like Mass Mutual, they have a dividend rate this year 6.6%, and the loan rate that they're giving is in the low 5%. After expenses, you might actually see some arbitrage in that policy. That's a pretty good deal, but it doesn't happen all the time that way. And there are other non-direct recognition carriers that their loan rate may be much higher than whatever the dividend rate is. So just because you have a non-direct recognition company doesn't mean you actually will experience arbitrage inside that policy. And that's where we're always considering these outside institutions. If we can get a loan from them, we get access to a very, very high percentage of our cash value, and generally at a low interest rate, as long as the outside interest rate environment is favorable.
And a lot of this comes down to these insurance carriers are in it for the long haul, getting good dividend crediting on secure assets. But these outside institutions, they're more subject to the market conditions. And when the Fed funds rate was dropped to near zero and interest rates, mortgage rates were in the 2s and 3s, you could see a 3% line of credit, 4% line of credit, really favorable borrowing rates against whole life in that kind of interest rate environment. But still, the dividends that were being paid, 5% or so, that is getting credited. And that's where you could have seen some arbitrage in a whole life carrier.
Yeah, and that was a realistic event. I had that happening in my policies until the outside interest rate environment changed. In 2022, rates shot up. Suddenly, my life insurance backed line of credit went from 3% all the way up to nearly 7%. And in that scenario, I just switched back to borrowing from the insurance companies because it made more sense and no chance for arbitrage outside of it.
And that's the thing. The power of this is the flexibility. You can combine these various lines of credit with different things, like maybe you're tapping a HELOC, and really, where is the most efficient place for you to tap funds, and where should you allocate your payments to pay down those interests first? When you think about things that way, I'm happy to have conversations about this. I think, James is as well. He's got actually good videos on this concept. And, it's important that you get into an understanding of how to most efficiently use your cash and your lines of credit.
Yeah, and if somebody's taking advantage of whole life and IUL, like we advocated for last week, and like I do in my personal life, we have different options among the different carriers, different loan types to choose from, different rates. And we're going to be able to go through the steps and look which one has the least impact, which one gives us the lowest rate, and we're going to make the best decision on who to borrow from at any given time. And these are conversations I love having with my clients.
Yeah, absolutely. Reach out to us if you're curious about these loans. I think that there's a lot of great options. The main thing is getting started to capitalize these policies so that you can even think about having a line of credit that you can access like this.
Appreciate you guys joining us this week. Next week, we're going to answer the question, shouldn't you just buy term and invest the difference? So many people advocate for that. What's the argument against it from our perspective? Or do we agree with it? Ooh, who knows? And with that, my name is James Barber. I'm your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.